We analyzed more than 500,000 accounts and we found a pattern that does something almost no other trading mistake does. It gets worse the more experienced you become. Look, most bad habits fade as traders improve. This one grows. Among brand new accounts, about 6% show it. Among traders who have been at it for more than 200 days, more than half do. And when it takes hold, it is one of the most expensive patterns we track. Fourth out of 23, costing the average affected trader around $7,000 over the life of their account. It's not revenge trading. It's not overtrading exactly. The pattern is called overcomplexity, running too many positions across too many markets at the same time. Quick context. I'm Jonas, I'm a trader myself, and I'm the founder of TradeMedic AI, a platform that analyzes trading behavior. That dataset of 500,000 accounts I just mentioned is all the traders we have already analyzed. It's why this channel can show you things most trading content can't. Right, so over complexity. If you ever sat down meaning to trade two clean setups and by mid-morning you were somehow managing 6 positions across Forex, indices and crypto, half forgetting your thesis on a couple of them. That's what we are talking about. Most traders have done it. I have done it. Here is what's happening. Every open trade needs a piece of you. A thesis, a level to watch, a reason to stay in or get out. Trading already asks for a lot of your attention. Analyzing, sizing, monitoring, managing your emotions. Past a certain point, adding one more position pushes the total load past what you can process. And the moment that happens, the quality of every decision of all your open trades starts to drop, not just the new one. It usually builds in 4 quiet steps. You open a few positions that each look good on their own. You keep adding because a new setup appears and holding more feels like you're doing more. Then attention runs out. There is too much open to watch properly, so you start reacting on instinct instead of your plan. And finally, decisions slip. Exits get sloppy, positions you didn't realize were correlated start canceling each other out, and performance fades across the whole account. The trades didn't get worse because your strategy changed. They got worse because there was more open than you could follow. Let's look at what this looks like across 500,000 accounts, because the shape of it surprised me. First, it is not that common. Only about 20% of traders show a measurable negative effect from overcomplexity. Out of the 23 patterns we track, it ranks about 19th for how often it shows up at all. So for most people, this is not the first thing to worry about. But here's where it flips. Rank those same 23 patterns by how much they cost the traders who have them, and overcomplexity jumps to 4th, around $7,000 per affected trader. So it is rare, but when it shows up, it bites hard. To put that in perspective, for the traders who have it, overcomplexity accounts for roughly 22% of everything they lose. Almost a quarter of their total losses trace back to this one pattern. And the way I'm measuring losses there is the sum of every losing trade over the life of the account, not the final number. Because traders win some, lose some, top up and keep going. So this is a real sizable slice of the damage, not a rounding error. The profitability numbers tell the same story. Across the whole data set, 18%, 1/8 of the traders are profitable. When overcomplexity is just one of someone's issues sitting in their top 5, that barely moves. About 16% are profitable. Top 3, 15%. But when it's their single biggest issue, profitability drops to 10, roughly half the baseline. The more this dominates your trading, the lower your odds. And then the part I mentioned at the start, it grows with experience. Under 10 days in, about 6% show it. Past 200 days, more than 50%. That is the opposite of almost every other pattern. And it's heavily a swing trader thing. Around 44% of swing traders show it, against only about 20% of day traders and only about 1% of scalpers. Which makes sense. Swing traders hold for days and naturally pile up overlapping positions. Scalpers are in and out too fast to really be affected by this. Now, to my favorite part. So, why do we do this? And specifically, why do more experienced traders do it more? It's tempting to call it a discipline problem and move on. Discipline is part of it, but there is some well-studied psychology underneath. And I think three things line up here. The first is just a hard ceiling on attention. Your working memory, the part of your mind that actively juggles live information, is small. The old estimate was the famous magical number 7. Later research by a psychologist called Nelson Cowan revised it down to about 4. 4 things you can really hold at once before something slips. Think about trying to keep a phone number in your head while someone reads your second one. The first one just dissolves. Open positions work the same way. By the 5th or 6th, you are past the ceiling and your brain quietly switches from careful analysis to fast gut reactions while feeling like you're in control. Now, here's the interesting flip side, and it's also the fix. Experts don't beat that limit with more memory, they beat it with more familiarity. There's a classic study on chess masters. They can glance at a real game position and recreate it almost perfectly, where a beginner can't, because the master sees a few familiar patterns where the beginner sees 20 separate pieces. But put random pieces on the board, no familiar patterns, and the master's advantage almost disappears. Hold on to that, it matters in a minute. The second bias is what sometimes called naive diversification. Faced with lots of options, people spread across all of them by default because breadth feels safer. There's research where people offered a menu of retirement funds, just split their money evenly across whatever was on the list, rather than really choosing. The menu shaped the portfolio more than analysis did. Trading does the same thing. The market puts a dozen setups in front of you, and spreading across several feels prudent, even when the extra ones aren't better, just more. And the third is illusion of control. More open positions feel like more command of the market, like you're covering more ground. A psychologist named Alan Langer showed people feel more in control the more actively involved they are, even when their actions change nothing. People value lottery tickets they pick themselves over random ones. Same odds. In trading, the extra positions mostly add noise, and spreading thin makes it harder to see how your trades interact. The feeling of control goes up, while the real control goes down. So, what helps? And the first thing to say is there's no universal right number. Some traders are sharp with 5 positions open, some lose the edge at 2. The number that matters is your number, the point where adding one more position starts dragging your average trade performance down. And this is exactly what Tradematic screens for in your own trade history. It groups every trade you've made by how many other positions you had open at the same time and compares your performance across those groups. If the trades you placed with a crowded book consistently did worse than the ones you placed with a clear one, it flags the pattern, finds your personal threshold, and then tells you what it had cost you in real dollar terms. not an estimate, your number from your data. Without that, honestly, you're guessing what your own limit is. Beyond knowing your number, three things work, and they work because they take the decision out of the heat of the moment. First, cap your concurrent positions and decide the cap when you're calm, not mid-session. When you're at the cap, nothing new opens until something closes. The reason to set it in advance is simple. The moment you're tempted to at the 7th position is exactly when your judgment is thinnest. Second, cap your total exposure across all your positions, not just per trade. Per trade risk limits feel protective, but they do nothing to stop you stacking 10 correlated positions into what is actually really just one giant bet. A ceiling on total risk closes that gap. And third, remember the chess master. The way to beat your attention limit isn't more capacity, it's familiarity. Trade with a focused shortlist of instruments you know well, rather than chasing whatever's moving. The data backs it up. Traders who concentrate their focus are far more often profitable than the ones who spread thin. If any of this sounded familiar, the single most useful thing you can do is find out whether it's in your data and where your personal threshold sits. You can connect your account to Tradematic for free. The link is in the description, and it'll show you whether overcomplexity is one of your patterns and what it's costing you. And one honest note to close, because this is uncommon, it's not the first thing most traders should fix. But if it does show up clearly in your data, take it seriously because it's costly. It dominates. And unlike most habits, it gets worse with time, not better. It rarely fixes itself. If this was useful, subscribe. We build every video on this channel from real behavioral data across hundreds of thousands of accounts. Thanks for watching and trade well.
Trade smarter today with Hoc-trade.